Welcome to this important financial disclaimer. Please pay close attention to the following information. It's crucial to understand the nature of the content you are about to consume. This disclaimer is here to clearly set the expectations regarding the information provided in this video or related materials. The content presented is for informational purposes only and should never be construed as professional financial advice. We are not licensed financial professionals, and the information shared is general in nature. The sole purpose of our content is educational and informational, designed to help you think about certain financial concepts. Any opinions or views expressed are strictly those of the author or speaker and do not represent professional endorsements or advice. It is absolutely vital to recognize the inherent risks associated with investing and financial decisions. Understand that every investment, regardless of how safe it may seem, carries some level of risk. There is a real possibility of losing some or all of your invested capital. Please be prepared for this reality. Past performance of any investment or strategy discussed is not a guarantee or reliable indicator of future results. Before making any financial decisions, we strongly urge you to consult with qualified professionals. This includes consulting with a qualified financial advisor, tax professional, or attorney relevant to your personal situation. Always conduct your own thorough research, or DYOR, before committing to any financial decisions or investments. In conclusion, your financial well-being is your sole responsibility. By proceeding with this content, you acknowledge and accept this financial disclaimer in its entirety. Thank you for watching and listening, and we wish you the best in your financial journey. Welcome to an in-depth look at how central banks exert control over commercial banking and key definitions in the banking world. Understanding the structure and control mechanisms of the banking system is crucial for grasping modern economics and financial stability. A central bank is the national banking authority responsible for managing a country's currency, money supply, and interest rates. It is the bank of banks and the government's bank. The central bank's main role is to maintain financial stability and implement monetary policy to achieve macroeconomic goals like low inflation and high employment. Central banks use several key tools to influence commercial banks and the broader money supply. These are the primary levers of monetary policy. Reserve requirements are the fraction of deposits commercial banks must hold, either in vault cash or on deposit at the central bank. Raising this ratio restricts banks' lending capacity. The discount rate, or bank rate, is the interest rate at which commercial banks can borrow money directly from the central bank. Changes here affect banks' cost of funds and, subsequently, their lending rates. Open market operations, or OMO, involve the central bank buying or selling government securities in the open market. Buying injects money, increasing lending capacity. Selling withdraws money, tightening credit. Beyond monetary policy, central banks act as the key regulator and supervisor for commercial banks, ensuring the safety and soundness of the financial system. The central bank determines which institutions can operate as banks by granting licenses and charters, ensuring only sound entities enter the banking industry. Prudential regulations, such as setting minimum capital adequacy ratios, mandate that banks hold enough capital relative to their risk exposure to absorb unexpected losses. Central banks conduct regular bank examinations and on-site oversight to monitor compliance with regulations and assess a bank's financial health, intervening when necessary. To fully understand banking operations, let's define some critical terms used across the financial sector. A commercial bank is a financial institution that accepts deposits, offers checking account services, makes business and personal loans, and offers basic investment products. Liquidity is the degree to which an asset or security can be quickly bought or sold in the market without affecting the asset's price. For a bank, it's the ability to meet short-term cash demands. Solvency is the ability of a bank to meet its long-term financial obligations. It typically relates to having sufficient capital to cover long-term liabilities and absorb losses. An interest rate is the amount charged by a lender to a borrower for the use of assets. It is typically expressed as a percentage of the principal and is critical in economic decision-making. The central bank is vital for controlling the money supply, regulating commercial banking activities, and stabilizing the national economy. Through monetary policy tools and stringent regulations, the central bank ensures that commercial banks operate responsibly and in alignment with national economic interests. This oversight is fundamental to promoting stability, protecting depositors, and ensuring trust in the overall financial system.
If you found this video helpful, Like, share, and subscribe for more simple finance explanations.